Welcome back to The Deep Dive. Today we are digging into the fallout from a really consequential new executive action.
The huge one.
Yeah, a presidential memorandum from the U.S. administration that's rolling back financial support for multilateral organizations. And I mean, on a massive scale.
Immediately. And yeah, on a massive scale. This isn't just a policy tweak, This is a structural realignment of global governance and aid financing.
So our mission today is to really give you, the investor, the intelligence you need to navigate this.
Exactly. We'll be looking at the immediate financial shock, some of the surprising legal conflicts this creates, and of course, the market volatility that comes from this new geopolitical vacuum.
If your business relies on that predictable foreign aid flow through or stable global regulations, this is essential listening.
Non-negotiable.
Okay, so let's unpack this. The core event first. People are calling it the 66 organization exodus.
And it happened fast. On Wednesday, January 7th, 2026, the administration signed the memorandum. And just like that, it directed the withdrawal of the U.S. from 66 international organizations.
The scope of that it's just hard to grasp.
It's unprecedented in modern U.S. history. We're talking about 31 UN entities and another 35 non-UN organizations.
So this is easily the administration's biggest retreat from multilateral engagement so far.
By far. It fundamentally changes the U.S. role in global dialogue, in research, and in aid delivery.
And what's the stated rationale? What has the White House said is the justification for this?
The official line centers on sovereignty and efficacy. They're claiming these organizations operate contrary to U.S. national interests, to security, economic prosperity, you name it.
So the argument is that these groups are advancing, globalist agendas?
That's the term they're using, yeah. Globalist agendas, that they're mismanaged or that they just fail to get meaningful results for the amount of U.S. money they take in.
The goal then is to redirect that funding.
Exactly, toward domestic America first priorities. Things like infrastructure and military readiness.
Okay, that structural change has massive financial implications. But to really understand the shock, we need to establish just how dominant the U.S. financial footprint was in the first place.
Yeah, you have to look at the hard figures. The U.S. has been the overwhelming financial engine of this whole system.
For a long time.
For a very long time. Between fiscal years 2008 and 2021, the U.S. contributed over $137 billion to international organizations.
$137 billion.
And most of that, over 3/4, went directly into the UN system.
So let's narrow in on the near-term impact. What was the budget looking like just before this happened?
In fiscal year 2021 alone, U.S. contributions topped $16 billion.
$16 billion. And to put that into context.
Well, that one-year contribution, that $16 billion, was greater than the combined financial support of 178 of the 193 UN member states. Yeah. I mean, the U.S. provides about a fifth, 19 to 20% of the entire UN system's revenue. So the U.S. isn't just a major player. It was the indispensable anchor of the system's budget.
What's fascinating here is the disparity, especially when you think about great power competition. China is the world's second largest economy. How did its contribution compare to the U.S., one that just vanished?
The gap is just colossal. And it really speaks to the financial hole that's just opened up. The U.S. provides 2 to 3 times more funding than the next highest government donor.
Okay, but what about China specifically?
More critically, the U.S. provides 6 times more financial support than China.
6 times?
6 times. China's voluntary contributions are a tiny fraction of what major Western donors provide. It doesn't reflect its economic size at all.
So for us, that disparity is the key indicator. That's where the financial stability was, and so that's where the influence vacuum is going to emerge.
Exactly. This withdrawal is 6 times more devastating to the budget than it would have been if contributions were, more evenly spread.
Now, before this withdrawal, were these contributions pretty steady, or did they react to global events?
Oh, they absolutely tracked crises. That's why the aid system became so dependent on them. We can actually trace 2 major surges in funding over the last decade.
Okay, tell us about the first one.
The first spike was after fiscal year 2015. It pushed the annual average up to around $11.5 billion.
And that was tied to what?
Directly to major humanitarian and refugee crises. We're talking about the conflicts in the Central African Republic and Syria, the displacement in Venezuela. That money flowed through groups like the World Food Program, the WFP, and the Red Cross.
And the second big surge?
That came after fiscal year 2019, and that's what got us up to that $16 billion mark we mentioned.
Right.
And this was driven by huge global health initiatives. the Global Fund to fight AIDS, tuberculosis, and malaria, UNICEF, the WFP again, and, importantly, the reversal of some prior funding cuts.
So that includes the money that went back to the World Health Organization, the WHO? Exactly.
And the UN Agency for Palestine Refugees, UNRWA. The U.S. was consistently stepping up to meet these demands, and now that spigot is it's shut off completely.
This is where things get really sticky, legally speaking. Because there's a kind of paradox here, isn't there? Previous attempts to exit some of these bodies, like the WHO, they were governed by a very specific set of rules.
That's right. What's so fascinating is that U.S. participation in some of these key groups is governed by old congressional resolutions, specifically the precedent from when the U.S. joined the WHO back in the 1940s.
And that required what exactly?
It required two non-negotiable conditions for withdrawal. First, a full 1-year notice. And second, and this is the immediate legal problem, the U.S. has to pay all its outstanding financial obligations for the current fiscal year before the withdrawal can be finalized.
So if this executive order says freeze all funds immediately and start withdrawing, the executive branch is putting itself in direct conflict with a congressionally mandated agreement.
That is the core conflict. If those assessed contributions for this fiscal year haven't been paid, which an immediate freeze implies, then the legality of the entire withdrawal is questionable at best.
So what's the administration's argument against that? Can they just say that the memorandum citing national interest overrides a resolution from 1948?
That would be their primary legal defense, sure, invoking executive authority in foreign policy. But that's where the issue of standing comes in. Who can actually challenge it?
You mean it's not just an issue for the UN?
Right. Congress itself could sue the executive branch. They could argue the administration is usurping their power over funding and treaties. Or the international organizations themselves could challenge the freeze in courts where they have jurisdiction.
So this raises a big question about long-term predictability, doesn't it? Will this action get tied up in court?
Potentially, yeah. And that could render the disengagement null and void for some of these organizations. It's a legal minefield.
Beyond the legal headaches, though, the political intent seems crystal clear. This isn't just a random withdrawal, is it? You can see an ideological focus in the targets.
Absolutely. The ideological intent is just as important as the financial impact. The White House explicitly targeted groups they see as pushing what they call progressive ideology and globalist agendas.
Can you give us some specific examples?
Yeah, the key organizations named are heavily focused on climate, energy, and governance standards. You saw the UN Framework Convention on Climate Change, the IPCC, the International Renewable Energy Agency, the International Solar Alliance, and so on.
So it's a complete pivot away from multilateral engagement on things like climate and labor practices.
A complete and immediate pivot.
Okay, let's pivot ourselves to the investor context, because this shock goes way beyond the foreign policy world. It's compounding an even larger financial dislocation.
That is the critical factor here. This 66 organization withdrawal is happening at the same time as another huge event. The dissolution of the U.S. Agency for International Development, USAID.
And for decades, USAID was the main channel for U.S. foreign aid.
It was the primary mechanism, yeah. It operated with an annual budget of $42.8 billion.
$42 billion. That single agency was 42% of global humanitarian aid flows. That's not a government problem. That is an immediate, deep, private sector shockwave.
It creates instant upheaval for U.S. businesses. We have to highlight the consequences for companies that historically relied on this money as a predictable revenue stream.
We talked about this fascinating figure before, the 46-cent flowback rule. Can you explain that again for our listeners?
Sure. Historically, for every dollar of assessed dues the U.S. paid to the World Health Organization, about 46 cents flowed right back to U.S.-based companies as procurement contracts.
So it was almost like a built-in insurance policy for these firms.
In a way, yes. They paid their dues, and nearly half that money cycled right back into their P&L. It supported American jobs, medical device suppliers, IT consultants, logistics firms.
And that 46-cent pipeline, which was built on stable multi-year federal contracts, has just evaporated.
Instantly. For publicly traded firms that relied on that flow-through, this creates an immediate crisis of liquidity and contract visibility. You can't hedge that in the short term.
And it's not just the general contracting sector. What about the massive life-saving programs? They must be facing a resource cliff.
An immediate one. Key initiatives like the Global Fund to fight AIDS, tuberculosis, and malaria, and Gavi, the Vaccine Alliance, are instantly destabilized.
And are we already seeing concrete examples of this disruption?
We are. For instance, PEPFAR, The president's emergency plan for AIDS relief is seeing fund freezes that are halting HIV clinics in El Salvador, stopping preventative medication programs in Guatemala.
What are the projected human costs of this sudden stop in services?
The humanitarian modeling is, frankly, it's grim. Because it happened so abruptly, services just stopping overnight, estimates suggest the disruption could lead to anywhere from 500,000 to 1 million preventable lives lost.
Wow.
All due to halts in medication supply, vaccine distribution, or clinical access.
And it's not just money and supplies. There's a loss of intellectual capital, too.
Exactly. The U.S. risks losing access to what experts call invaluable and irreplaceable data.
Data coordinated through whom?
Through 72 World Health Organization collaborating centers. They're spread across 18 U.S. states and D.C. This is essential public health surveillance research, early warning data that the U.S. relies on for its own protection. We're losing the ability to see the global health picture clearly.
So the U.S. pulls back its money, its influence, its access to data. If we connect this to the bigger picture, who steps into that huge geopolitical vacuum?
Well, other major economies are now structurally positioned to capitalize on this. The European Union, the BRICS nations, and most strategically, China.
And they're not necessarily going to just write a check for $6.
But they can set alternative global standards in public health, development, climate policy. The real power play is in standard setting.
How does that work?
Well, they can challenge the Western-led development model. They can impose different regulatory frameworks, maybe prioritize infrastructure over human rights conditions, or promote their own homegrown tech in areas like digital health.
So the U.S. is walking away from the table, letting competitors write the new rules.
That's the long-term risk, yes.
So what's the critical strategic takeaway for the market from all this chaos?
The chaos is accelerating a structural shift that was already underway. We're seeing a really forceful push away from centralized Western aid dependency toward what recipient nations are calling health sovereignty.
Health sovereignty. So nations in the global south, like Nigeria, are using this moment to declare self-reliance.
That's it, exactly. They're creating mandates for a long-term pivot toward domestic investment in resilient national health systems, local manufacturing, local supply chains.
This is a durable market dislocation, then. It's creating new demand signals that are national and sustainable, replacing the volatile donor funding model.
That is the structural shift investors need to recognize.
Which brings us to our segment where we try to synthesize this uncertainty into something actionable. This sudden shock has created a pretty asymmetric risk-reward profile.
This is not financial advice.
Yeah.
But, the market has been fundamentally broken by this pivot. We've gone overnight from predictable, centralized U.S. aid flows to decentralized national health spending. This is the kind of dislocation traders look for.
We've mapped the chaos. So what's the most outrageous but plausible way to play this?
We're pitching a dual-armed geopolitical health short-long strategy.
Okay, let's start with the immediate fallout. Where's the short opportunity?
The short. You target U.S.-based, publicly traded professional services or large contractor firms, the ones whose revenue models rely heavily on subcontracts tied to these frozen U.S. foreign aid budgets.
So companies dependent on USAID, the Global Fund, Pepsi are?
Right. Their revenue visibility, which was anchored by stable multi-year federal contracts, has just dropped to zero in this segment. It's an immediate crisis of liquidity and backlog visibility for them.
And the corresponding long position to hedge that risk. The bet on the future structural shift.
The long. You simultaneously establish a long position in mid-cap, regionally focused healthcare tech and logistics companies, particularly those in high-growth African markets like Nigeria and Kenya.
The firms that are pushing for and benefiting from these new health sovereignty initiatives.
Precisely. The rationale is that the new national fiscal priority will replace the old donor dependency.
So these local firms are positioned to benefit as national budgets prioritize local supply chains and digital infrastructure.
Exactly. They're solving a newly nationalized problem, which provides a much stronger, more sustainable demand signal than volatile foreign aid ever could. It's a bet on the localization of global health.
That is a very compelling pivot. So to quickly recap the takeaways, this executive action delivers an immediate financial crisis to global organizations while creating some serious legal conflicts with U.S. domestic law.
And structurally, the most critical shift is the geopolitical vacuum. It's accelerating the move toward regionalized, decentralized health markets powered by national mandates, not external aid.
So what does this all mean for the future of global health? We'll leave you with this final provocative thought to consider. If this abrupt action forces nations in Africa and the Global South to invest internally to build resilient, self-funded, digitally enhanced health infrastructure independent of Western aid, will the long-term unintended consequence be a more robust and decentralized global health system?
And if so, how does capital need to flow next to facilitate that transition? Think about that flow and where that money is now mandated to land.
Thank you for joining us for this deep dive into a pivotal moment in global governance and finance. We encourage you to explore the context further.